Income tax law and practice. Provident Fund. In this video, I'm going to show how to calculate the taxable portion of Provident Fund. First of all, let us understand what is Provident Fund. Provident Fund is a savings scheme set up by government for employees for future security. It is saving fund in which employer and employee contributes to the fund in fixed percentages. The fund gets credited interest to employee's account. The types of provident fund, there are four types. First one is statutory provident fund. This fund is provided for government employees. And second one is recognized provident fund. Recognized provident fund means when income tax authorities, the commissioner of income tax department is recognized the fund, which is called recognized provident fund. And the third one, unrecognized provident fund. Unrecognized provident fund is a fund which is not approved by the commissioner of income tax. And last one, public provident fund. Public provident fund is fund which is set up for salaried employees, and in public provident fund the only employees contribution not be there, only employers contribution will be there. Treatment of tax. There are four types of provident funds, as I told. How to consider them for treatment of tax? First of all, we should understand that the provident fund, there is a contribution by employee and employer to that fund in certain or fixed first percentages. There is a employer's contribution as well as employee's contribution, and every year the provident fund gets credited the certain percentage of interest. First of all, statutory provident fund. Here, statutory provident fund, employer's contribution is fully exempt, and employee's contribution is considered under section 80C, and interest credit to the statutory provident fund is fully exempt, and payment received at the time of retirement is also fully exempt. Second one, recognized provident fund. For recognized provident fund, when employer contributes, that is taxable. How much? About 12%. The employer's contribution to that fund, the 12% of basic salary, up to 12% of basic salary is exempt. Above that is taxable. Then employee's contribution to the recognized provident fund is considered under deduction under section 80C. Then interest accumulated and credited to that recognized provident fund is taxable if interest exceeds 9.5%. The interest exceeds 9.5% will be taxable. Then payment received at the time of retirement is fully exempt for recognized provident fund. Then unrecognized provident fund, employer's contribution fully exempt, employee's contribution not available under section 80C, then interest credited is fully exempt, payment received at the time of retirement is also fully payment received at the time of retirement is fully taxable, that is unrecognized provident fund. Then public provident fund, there is no employer's contribution, then employee's contribution will be taken under section 80C, then interest fully exempt, then payment received at the time of retirement also fully exempt. In these four types, we should look the recognized provident fund, employer's contribution, interest credited. Let us understand with a problem. Mr. Prabhakar is an employee in a company in Bangalore. He provides these information. First one is basic salary 8,000 per month, dearness allowance rupees 2,000 per month, dearness allowance rupees 2,000 per month, then the 1,000 per month enters into retirement benefits, commission on turnover rupees 2,000. Company has contributed to his recognized provident fund at 14% of his salary, and he contributed equal amount. See here, for recognized provident fund, employer contributes 14% and employee also contributes the same amount. Then fifth one, interest above fund is rupees 14,000 at the rate of 14%. Interest is credited to that provident fund, rupees 14,000, that is in at the rate of 14%. So in point 4 and 5, the employer contribution that provident fund up to 12% is exempt, remaining is taxable, in the sense 2% is taxable. 14 minus 12 equals 2, 2% is taxable. Then fifth one, interest is 14%. In 14%, 9 up to 9.5% is exempt, above is taxable. Let us calculate that. Solution: calculation of taxable recognized provident fund. First one, first we should check the 14% of basic salary, how much will come. Here, what is the basic salary we should consider? For calculation of recognized provident fund, the basic salary is basic salary. The meaning of basic salary is basic salary plus dearness allowance, only part of retirement, then commission on turnover. Only three benefits will be considered. Here basic salary is 8,000 per month, for 12 months 96,000. Dearness allowance here 2,000 is in 2000, 1000 is retirement benefit, so we have to take only 1000. 1000 in 12, 12,000. 96,000 plus 12,000 plus commission on turnover, rupees, commission turnover is rupees 2000. So the total 1,10,000 into 14% equals 15,400, less exempt up to 12%. For 1,10,000 at the rate of 12% equals 13,200. So when we deduct 15,400, 15,400 minus 13,200 equals taxable portion of RPF equals 2,200. So we have to consider 2,200. Next, let us see the interest credited, that is how much is taxable. Here calculation of taxable interest on RPF. First one, here fifth point, let us look at fifth point. 14,000 is at the rate of 14%, so interest at 14% equals 14,000. We should deduct 9.5%, because up to 9.5% is exempt. Here how much will come at 9.5%? 9.5%, 14,000 into 9.5 divided by 14. So for 14%, 9.5% equals 9,500. Remaining is taxable. Taxable interest on RPF equals 4,500. So this is how we are going to calculate the taxable portion of the RPF. Here basic meaning of basic salary equals basic plus dearness allowance, retirement portion plus commission on turnover. 96,000 plus 12,000 plus 2,000 equals 1,10,000. Hope you have understood this. Thank you.